Let me tell you about a moment that still keeps me up at night. It was March of 2020. The world was falling apart. The stock market had crashed 34% in 23 trading days. Businesses were shutting down, people were dying, and I was sitting in my office watching screens flash red while trying to figure out how to protect billions of dollars of my investors' capital. In that moment, everything I thought I knew about portfolio construction was being tested. Positions I had studied for months, companies I understood deeply, were being sold indiscriminately. It did not matter if the business was good or bad. It did not matter if the valuation was cheap or expensive. Everything was getting crushed. But here is what separated that experience from a total disaster. I had prepared for this moment. Not that specific moment. Not a pandemic, but a moment of extreme market stress. I had thought about what could go wrong. I had positioned our portfolio to survive the worst-case scenario. And because of that preparation, we not only survived, we thrived. We turned $27 million into $2.6 billion in a matter of weeks through hedges we had put in place before the crash. That experience crystallized everything I had learned about building portfolios that can withstand market crashes. And today, I am going to share with you exactly how I would build a crash-proof portfolio from scratch. Not crash-resistant. Not crash-tolerant. Crash-proof. A portfolio designed to survive the absolute worst the market can throw at it while still generating attractive long-term returns. Now let me be clear about what I mean by crash-proof. I do not mean a portfolio that never goes down. That is impossible. Unless you hold nothing but cash, and even cash loses purchasing power to inflation. What I mean is a portfolio that can withstand a 50% market decline without forcing you to sell at the bottom, without destroying your financial security, and without preventing you from taking advantage of the opportunities that crashes create. This is a fundamentally different way of thinking about investing than what most people practice. Most people build portfolios to maximize returns in good times. They ask, how can I make as much money as possible when markets go up? That is the wrong question. The right question is, how can I survive when markets go down so that I am still around to benefit when they recover? Because here is the mathematical reality that most investors do not understand. Avoiding losses is more valuable than capturing gains. If your portfolio drops 50%, you need a 100% gain just to get back to even. If you can limit your decline to 20% while the market falls 50%, you need only a 25% gain to get back to your starting point. The math strongly favors defense over offense. Let me walk you through the exact framework I would use to build a crash-proof portfolio today. This is not theoretical. This is how I actually think about portfolio construction after 30 years of managing money through multiple market cycles. The first pillar of a crash-proof portfolio is what I call quality concentration. This might sound contradictory. How can concentration be crash-proof? Does not diversification protect you from crashes? Here is what I have learned. Diversification protects you from company-specific risk, the risk that any single company fails. But it does not protect you from market risk, the risk that all stocks decline together. In a crash, everything goes down. Your diversified portfolio of 50 stocks falls just as much as a concentrated portfolio of 10 stocks, maybe more. Because a diversified portfolio usually includes a lot of mediocre companies that get absolutely destroyed in downturns, what protects you in a crash is not the number of stocks you own. It is the quality of the stocks you own. High-quality businesses with strong balance sheets, durable competitive advantages, and essential products and services decline less in crashes and recover faster afterward. They have the financial strength to survive tough times. They have the competitive position to take market share from weaker rivals who fail. They emerge from crashes stronger than they entered. So the first element of my crash-proof portfolio is 8 to 12 extremely high-quality businesses that I understand deeply. Not 50 stocks I sort of know about, not an index fund that owns everything. A concentrated portfolio of the best businesses in the world. What makes a business high quality for crash-proof purposes? Let me give you the specific criteria I use. First, the business must have low or no debt. Debt is what kills companies in crashes. When revenue declines and cash flow drops, debt payments still come due. Companies with too much debt face bankruptcy. Companies with little or no debt can weather any storm. They do not need to access capital markets when capital markets are frozen. They do not need to sell assets at distressed prices to service their obligations. They simply wait out the storm. Second, the business must sell essential products or services. In a severe recession, consumers and businesses cut discretionary spending. They stop buying luxury goods. They cancel vacations. They defer purchases they do not absolutely need. But they keep buying essential goods and services. They keep buying food, healthcare, utilities, and financial services. Companies that sell essentials see their revenue decline less than companies that sell discretionary items. Third, the business must have pricing power. Inflation often accompanies or follows economic crises. Companies without pricing power see their margins compressed as costs rise faster than prices. Companies with strong brands and competitive moats can raise prices to offset cost increases. This protects their profitability through difficult environments. Fourth, the business must generate strong free cash flow. Cash flow is what keeps companies alive during crashes. Companies that generate more cash than they spend have options. They can buy back shares at depressed prices. They can acquire struggling competitors cheaply. They can invest in growth while rivals are retrenching. Companies that consume cash have no options. They are at the mercy of capital markets that may be closed to them. Fifth, the business must have proven management. In a crisis, management quality matters enormously. Good managers make tough decisions quickly. They cut costs without destroying the business. They protect the balance sheet. They communicate honestly with stakeholders. Bad managers freeze, deny reality, and make the situation worse. I want to own companies run by managers who have navigated difficult environments before and done so successfully. If I apply these 5 criteria rigorously, I end up with a short list of companies that can survive anything. Consumer staples companies that sell products people need, regardless of economic conditions. Healthcare companies that benefit from aging demographics and provide essential services. Financial infrastructure companies that facilitate transactions regardless of market direction. Industrial companies that maintain and operate essential infrastructure. These companies will not be the best performers in a raging bull market. They will lag the high-flying technology stocks and speculative growth stories. But when the crash comes, they will decline less, and when the recovery begins, they will still be standing while many of their peers have failed. The second pillar of a crash-proof portfolio is substantial cash reserves. This is the element that most investors get wrong. They think holding cash is a drag on returns. They feel like they are missing out when markets go up and their cash sits there earning little, so they stay fully invested at all times. This is a critical error. Cash is not just a low-returning asset. Cash is optionality. Cash is the ability to take advantage of opportunities when they arise. Cash is what allows you to be greedy when others are fearful. Think about what happens during a crash. Stock prices fall dramatically. Businesses that were expensive become cheap. Opportunities appear that may not come again for years or even decades. The investors who can take advantage of these opportunities are the ones who have cash. The investors who are fully invested can only watch helplessly as prices fall. I would hold 20 to 30% of my crash-proof portfolio in cash or short-term treasury bills. Yes, that is a lot. Yes, it will reduce returns in bull markets, but it serves 2 essential functions. First, it reduces the overall volatility of the portfolio. If stocks fall 50% and you are only 70% invested in stocks, your portfolio falls 35% instead of 50%. That 15 percentage point difference is enormous psychologically and mathematically. You need a much smaller gain to recover. You can sleep at night. You can think clearly instead of panicking. Second, it gives you the firepower to buy aggressively when prices are depressed. Some of the best investments of my career have been made during crashes when I was able to deploy cash into high-quality businesses at distressed prices. Without that cash, I would have missed those opportunities. The returns I generated by buying during crashes more than compensated for the drag of holding cash during bull markets. Now, some people will say that I should hold bonds instead of cash. After all, bonds typically rally during stock market crashes as investors flee to safety. This is true historically, and I do think bonds have a place in a crash-proof portfolio. But I am cautious about long-duration bonds right now for reasons I will explain. We are in an environment of elevated government debt and persistent inflation pressures. Interest rates may stay higher for longer than most people expect. Long-duration bonds lose value when interest rates rise. A 30-year Treasury bond can decline 20% or more if rates rise by just 1 percentage point. That is not the kind of volatility I want in the defensive part of my portfolio, so I prefer to keep the defensive allocation mostly in cash and short-term treasuries. These do not lose value when rates rise. They provide immediate liquidity when opportunities appear. They let me sleep at night knowing that a significant portion of my portfolio cannot decline in nominal terms. The third pillar of a crash-proof portfolio is selective hedging. This is more advanced and not appropriate for everyone, but for sophisticated investors who understand derivatives, hedging can provide additional crash protection that enhances the portfolio's resilience. The key word is selective. I am not talking about constantly hedging the portfolio, which is expensive and usually counterproductive. I am talking about putting on hedges when market conditions suggest elevated risk and when the cost of protection is reasonable. In early 2020, I became convinced that the coronavirus would have a much larger economic impact than markets were pricing in. I bought credit default swaps on corporate bond indices, essentially betting that credit spreads would widen dramatically. The cost of these hedges was modest relative to the protection they provided. When the crash came, those hedges paid off enormously, turning $27 million into $2.6 billion. But here is what I want you to understand. That hedge was not random speculation. It was a calculated bet based on specific analysis of a specific risk that I believe the market was mispricing. I do not hedge all the time. I do not try to protect against every possible risk. That would be too expensive and too complicated. I hedge selectively when I see specific risks that the market is underestimating, and when the cost of protection is attractive. For most investors, I would not recommend trying to hedge with derivatives. The transaction costs are high. The timing is difficult. The instruments are complex. It is easy to lose money even when you are right about the direction. If you do not have significant experience with options and other derivatives, stick with the first two pillars, quality concentration and cash reserves. Those will provide substantial protection without the complexity and cost of hedging. The fourth pillar of a crash-proof portfolio is geographic and currency diversification. This is about protecting yourself from risks specific to any single country or currency. Most investors have extreme home country bias. American investors own mostly American stocks. European investors own mostly European stocks. This feels comfortable because, the companies and understand the economy, but it concentrates risk in ways that may not be obvious. What if the United States experiences a prolonged period of economic weakness while other regions thrive? What if the dollar declines significantly against other currencies? What if policy mistakes or political instability create problems specific to the American economy? These are not outlandish scenarios. They have happened before and will happen again. A truly crash-proof portfolio should have meaningful exposure to businesses that operate globally or are headquartered in different regions. Not because foreign stocks are necessarily better than American stocks, but because diversification across geographies reduces the risk that any single country's problems destroy your wealth. I would allocate perhaps 20 to 30% of the equity portion of my portfolio to businesses with substantial non-US operations or to high-quality foreign companies. This provides a hedge against specific risks while maintaining exposure to global economic growth. The fifth pillar of a crash-proof portfolio is what I call anti-fragile positioning. This concept comes from the writer Nassim Taleb. An anti-fragile system does not just survive shocks, it actually benefits from them. It gets stronger when stressed. How do you build anti-fragility into a portfolio? By owning businesses that benefit from disorder, and by having the resources to take advantage of opportunities that chaos creates. Some businesses are naturally anti-fragile. They get stronger during crises because their competitors weaken or fail. Think about a dominant retailer during a recession. Weaker retailers go bankrupt. The dominant player absorbs their customers and market share. When the economy recovers, they emerge with a stronger competitive position than they had before. Or think about a well-capitalized bank during a financial crisis. Weak banks fail or are forced to merge. Strong banks acquire their assets at distressed prices and expand their market position. They earn extraordinary returns on the investments they make during the crisis. I want to own businesses with these characteristics. Businesses with strong balance sheets that can make opportunistic acquisitions during downturns. Businesses with dominant market positions that can capture share from failing competitors. Businesses with the management capability to navigate crises and emerge stronger on the other side, combined with the cash reserves I mentioned earlier. This creates a portfolio that can actually take advantage of crashes rather than just surviving them. While other investors are panicking and selling, I can be calm and buying. While other investors are watching opportunities pass them by, I can be acting decisively. Now let me put these 5 pillars together into a specific portfolio allocation. This is how I would actually structure a crash-proof portfolio today. 40 to 50% would be in high-quality equities. These would be 8 to 12 carefully selected businesses, meeting all the quality criteria I described. Low debt, essential products, pricing power, strong cash flow, proven management. This is the core of the portfolio, the engine of long-term returns. 20 to 30% would be in cash or short-term treasury bills. This is the defensive ballast, the protection against severe declines, and the optionality to buy opportunities during crashes. I would keep this in instruments with minimal duration risk and maximum liquidity. 10 to 15% would be in intermediate-term government bonds. These provide some yield enhancement over cash while maintaining defensive characteristics. I would avoid long-duration bonds due to interest rate risk, but intermediate-term bonds with 3 to 7 year maturities offer a reasonable balance. 5 to 10% would be in gold or other hard assets. This is insurance against extreme scenarios like currency crisis, hyperinflation, or loss of confidence in government bonds. I do not expect to earn significant returns on this allocation, but it provides protection in scenarios where everything else fails. The remaining allocation would depend on individual circumstances and could include international equities, real estate, or other alternative assets that provide diversification and potential returns. Let me now talk about how this portfolio would perform in different scenarios, because crash-proof does not mean perfect in all environments. It means resilient in the worst environments while still providing acceptable returns in normal environments. In a normal bull market, this portfolio will underperform. The cash and bond allocation will drag on returns. The focus on quality value stocks will lag when speculative growth is leading. An investor fully invested in high-flying technology stocks will look smarter in the short term. This is the price you pay for crash protection. But here is what I have learned over 30 years. Bull markets do not last forever, and the investors who look smartest at the top of bull markets often look the dumbest at the bottom. They give back all their gains and more. Meanwhile, the crash-proof portfolio keeps compounding steadily through the cycle. In a mild correction of 10 to 20%, this portfolio will decline less than the market. The quality stocks will fall less than average. The cash and bonds will provide stability. The overall decline might be half or 2/3 of the market decline. Unpleasant but manageable. In a severe crash of 40 to 50%, this portfolio will demonstrate its value. The high-quality stocks will decline but not as much as the average stock. They will not face bankruptcy risk. Their dividends will likely continue. The cash and bonds will hold their value. The overall portfolio might decline 20 to 30%, while the market falls 50%. More importantly, the portfolio will have the resources to buy aggressively during the crash, setting up enormous returns in the recovery. In a depression or systemic crisis, the gold allocation provides additional protection. If there is a genuine loss of confidence in the financial system, gold has historically served as a store of value. I do not think this scenario is likely, but the insurance is cheap relative to the protection it provides. Let me address some common objections to this approach. The first objection is that holding cash is too expensive. You are giving up returns in bull markets. This is true, but you are also buying insurance against catastrophic loss. Insurance has a cost. That cost is worth paying if it protects you from ruin. Think about it this way. You probably have homeowners insurance, even though your house is unlikely to burn down. You probably have health insurance even though you are probably healthy. You accept these costs because the downside of being uninsured is catastrophic. Portfolio insurance through cash reserves works the same way. The cost is real, but the protection is essential. The second objection is that this approach is too conservative for young investors with long time horizons. Why worry about crashes when you have decades to recover? This objection has some merit. A 25-year-old can probably afford to take more risk than a 65-year-old. But I would push back on the idea that young investors should ignore crash protection entirely. Behavioral finance research shows that investors who experience large losses early in their investing careers often become permanently risk-averse. They sell at the bottom, lock in their losses, and never return to the market. The emotional trauma scars them for life. A young investor with a crash-proof portfolio will experience smaller losses during downturns. They will maintain the psychological resilience to stay invested. They will have the resources to buy more at lower prices. Over a full career, this approach may actually generate better returns than a more aggressive approach that leads to panic selling during crashes. The third objection is that you cannot time when to raise cash or add hedges. If crashes are unpredictable, how do you know when to prepare? The answer is that you do not try to time anything. You maintain the crash-proof allocation at all times. You always hold 20 to 30% cash. You always own high-quality businesses. You always have some gold. The protection is permanent, not tactical. Yes, there may be periods when the cash looks like a drag and you wish you were more aggressively invested, but those periods are exactly when crashes become most likely. Bull markets breed complacency. Investors abandon defensive positions because they seem unnecessary, and then the crash comes and they wish they had been more conservative. I would rather earn slightly lower returns in bull markets and be fully protected in crashes than chase maximum returns and risk catastrophic loss. That trade-off is easy for me. Let me close with some thoughts on the psychology of crash-proof investing. Because the biggest challenge is not constructing the portfolio. The biggest challenge is maintaining the discipline to stick with it through different market environments. In bull markets, you will feel left behind. Your friends and colleagues will brag about their returns in speculative stocks. The financial media will celebrate the investors who took big risks and won. You will question whether your conservative approach makes sense. In these moments, remember that the race is not to the swift. Investing is not a sprint. It is a marathon. The goal is not to have the best returns in any single year. The goal is to compound wealth over decades, without suffering catastrophic losses that set you back years. In crashes, you will feel scared. Even with a crash-proof portfolio, you will experience losses. The news will be terrifying. Experts will predict that things will get worse. Every instinct will tell you to sell and hide in cash. In these moments, remember why you built the portfolio the way you did. You prepared for this. You have cash to buy opportunities. You own businesses that will survive. You do not need to panic because you are not at risk of ruin. This is the moment your preparation pays off. Stay calm, follow your plan, buy when others are selling. The investors who build wealth over lifetimes are not the ones who take the most risk. They are the ones who survive. They are the ones who are still in the game after every crash. They are the ones who compound steadily decade after decade without suffering permanent impairment. That is what crash-proof investing is about. It is about survival. It is about being able to stay invested through any environment. It is about sleeping well at night regardless of what the market does tomorrow. I have been investing for over 30 years. I have lived through multiple crashes. I have made money, and I have lost money. And if there is one lesson that stands out above all others, it is this. Defense wins championships. Protect your capital first. Let growth take care of itself. Build a portfolio that can survive anything. Own quality businesses with strong balance sheets. Hold meaningful cash reserves. Diversify across geographies. Position for anti-fragility. And maintain the discipline to stick with your approach through bull markets and bear markets alike. Do this, and you will not just survive the next crash. You will thrive. You will have the resources to buy when others are selling. You will have the psychological resilience to stay calm when others are panicking, and you will emerge from the crash wealthier and stronger than you entered it. That is the promise of crash-proof investing. Not that you will never lose money, not that you will beat the market every year, but that you will be standing at the end, that you will have protected what you have built, and that you will be positioned to take advantage of whatever opportunities the future brings. That is how I think about building portfolios. That is how I would invest if I were starting from scratch today. And that is what I hope you will take away from this discussion. Protect yourself first. Everything else follows from that foundation. But let me go deeper on something that I think deserves more attention. Let me talk about the specific types of businesses that belong in the quality equity portion of a crash-proof portfolio, because understanding what makes a business crash-resistant at a fundamental level is the key to making good selections. The first category I would look at is consumer staples. These are companies that sell products people buy regardless of economic conditions. Think about what you purchase when times are tough. You still buy toothpaste, you still buy food, you still buy cleaning products. You might trade down to cheaper brands, but you do not stop buying entirely. The best consumer staples companies have several characteristics that make them crash-proof. They have brands that consumers trust and are willing to pay a premium for. Even during recessions, they have global distribution that provides diversification across economies. They have pricing power because their brands are difficult to replicate. And they generate enormous free cash flow that can be returned to shareholders. During the 2008 financial crisis, consumer staple stocks declined about 25%, while the overall market fell over 50%. During the 2020 crash, they again outperformed significantly. This pattern repeats in every downturn because demand for essential products is stable, regardless of economic conditions. The second category I would look at is healthcare. This is perhaps the most defensive sector in the entire market. Healthcare spending is not discretionary. People do not choose to get sick. They do not postpone necessary medical treatments because the economy is weak. In fact, healthcare spending often increases during downturns as stress-related illnesses rise, but you have to be selective within healthcare. Pharmaceutical companies face patent cliffs and pipeline risks that can cause dramatic declines. Biotechnology companies are essentially binary bets that can go to zero. Hospital operators face regulatory and reimbursement uncertainties. The healthcare companies I favor for crash-proof portfolios are the ones that provide essential infrastructure or services that the healthcare system cannot function without. Medical device companies that manufacture the equipment used in hospitals. Diagnostic companies that enable disease detection. Healthcare distributors that ensure medicines reach patients. These businesses have stable demand regardless of which drugs are successful or which treatments are in favor. The third category I would look at is financial infrastructure. I am not talking about banks, which are highly leveraged and vulnerable to credit cycles. I am talking about the companies that facilitate financial transactions regardless of market direction. Payment networks are perfect examples. Every time someone swipes a credit card, taps their phone, or makes an online purchase, the payment network takes a small fee. They do not care whether the purchase is discretionary or essential. They do not care whether the economy is booming or crashing. They just clip their percentage of every transaction. During the 2008 crisis, payment networks declined less than banks and recovered faster. During the 2020 crash, they bounced back almost immediately as consumers shifted spending online. These businesses are essential infrastructure for the modern economy, and their revenue is remarkably stable through cycles. Stock exchanges and financial data providers fall into the same category. Trading volumes actually increase during market volatility. Financial data becomes more valuable when uncertainty is high. These businesses can actually benefit from the conditions that destroy other companies. Fourth category I would look at is utilities and essential infrastructure. These are businesses that provide services society cannot function without: electricity, water, waste management, communications infrastructure. These services are consumed regardless of economic conditions. The challenge with utilities is that they typically carry significant debt. This makes them less crash-proof than I would like, but the ones with strong balance sheets and regulated returns can be very stable through downturns. The key is selectivity. Focus on utilities with conservative capital structures, diversified service territories, and stable regulatory environments. The fifth category I would look at is what I call toll booth businesses. These are companies that collect a small fee every time some essential activity occurs. They do not take inventory risk. They do not take credit risk. They just sit in the middle of important transactions and collect their toll. Railroads are a classic example. They own irreplaceable infrastructure that took over a century to build. Every time freight moves across the country, they collect their fee. The demand for freight transportation is relatively stable through cycles, because goods still need to move even during recessions. Data centers and cloud infrastructure are a more modern example. Every time someone uses an app, streams a video, or sends an email, they are using computing infrastructure that someone owns and operates. The demand for digital infrastructure only grows over time, and the companies that own this infrastructure earn stable, recurring fees. Let me now talk about position sizing within the equity portion of the portfolio. This is something most investors do not think about carefully, but it is crucial for crash protection. I would not put more than 15% of my total portfolio, or about 25 to 30% of my equity allocation, in any single stock, even for a company I love, even for a business I have studied for years. Concentration beyond this level creates unnecessary risk. Why? Because no matter how well I analyze a company, there are always unknowns. There are always risks I cannot anticipate. A fraud could be discovered. A regulatory change could destroy the business model. A competitor could emerge that I did not foresee. These tail risks are small for any individual company, but they are not zero. And if too much of my portfolio is in a single stock, when one of these tail risks materializes, the damage could be catastrophic within the equity allocation. I would also think about diversification across the crash-proof categories I described. I would not want all my stocks in consumer staples. Even though that is a defensive sector, I would want some consumer staples, some healthcare, some financial infrastructure, some utilities, some toll booth businesses. This ensures that sector-specific risks do not overwhelm the portfolio. Let me also talk about dividend considerations for a crash-proof portfolio. Dividends serve two important functions during market downturns. First, dividends provide income that you can live on without selling shares if you need cash during a crash. Selling shares locks in your losses at the worst possible time. But if your portfolio generates enough dividend income to cover your expenses, you never have to sell. You can wait out the storm while your dividends pay your bills. Second, dividends provide a psychological anchor during crashes. When stock prices are falling and the news is terrifying, it is easy to panic and sell. But if you focus on dividend income rather than portfolio value, the picture looks different. Your stocks may be down 30%, but your dividend income is stable or even growing. This reframing helps you maintain perspective and avoid panic selling. For a crash-proof portfolio, I would want an overall dividend yield of at least 2 to 3%. This means prioritizing dividend, paying stocks within my equity allocation, and reinvesting those dividends during accumulation years. Over time, dividend growth will increase your income stream and provide growing protection against inflation. Let me discuss the rebalancing process for a crash-proof portfolio. Rebalancing is essential for maintaining the crash protection over time, but it needs to be done thoughtfully. In a bull market, stocks will outperform cash and bonds. Your equity allocation will drift higher as a percentage of the portfolio. Without rebalancing, you will gradually become more aggressive, just as risk is increasing. This is dangerous. I would rebalance annually or whenever allocations drift more than 5 percentage points from targets. If stocks have a great year and grow from 50% to 60% of the portfolio, I would sell some stocks and add to cash and bonds to get back to 50%. This forces me to sell high and buy low systematically. In a crash, the opposite happens. Stocks fall and become a smaller percentage of the portfolio. Cash and bonds become a larger percentage. At some point, rebalancing means buying more stocks at depressed prices. This is exactly what you want to do, but it requires courage. Rebalancing forces you to buy when everything feels terrible, and every instinct tells you to hide. The discipline of systematic rebalancing removes emotion from the equation. You do not have to decide whether it is a good time to buy stocks. The rebalancing rules tell you to buy when stocks have declined relative to your target. You just follow the rules regardless of how you feel. Let me share a few more thoughts on the psychological dimension of crash-proof investing, because the biggest enemy of a crash-proof portfolio is the investor themselves. The first psychological challenge is patience. A crash-proof portfolio will underperform during bull markets. Your neighbors and coworkers will brag about their returns. The financial media will celebrate aggressive investors who took big risks and won. You will feel like you are missing out. But missing out is not the same as losing. If you miss some upside in a bull market but avoid catastrophic losses in a crash, you will be far ahead over a full cycle. The investors who look smart during bull markets often look foolish after crashes. Stay focused on the long term. The second psychological challenge is courage. When crashes happen, you need to be brave enough to maintain your positions and even buy more. This is extremely difficult. Every instinct tells you to sell and hide. The news is terrifying. Experts are predicting further declines. It feels like the world is ending. In these moments, remember that crashes are temporary. Every crash in history has eventually been followed by a recovery. The investors who bought during crashes earned extraordinary returns. The investors who sold locked in their losses and missed the recovery. Be brave. Follow your plan. Buy when others are selling. The third psychological challenge is humility. No matter how good your analysis, you will make mistakes. Some of your crash-proof stocks will turn out to be not so crash-proof. Some risks will materialize that you did not anticipate. You need the humility to recognize mistakes quickly and correct them, rather than hoping for recovery. Humility also means accepting that you cannot predict the timing of crashes. You do not know when the next crash will happen. It could be next month or next decade. This uncertainty is why you maintain crash protection at all times, rather than trying to time when to add it. Let me conclude with a story that illustrates why crash-proof investing matters so much. I know an investor who retired in 2007 with what he thought was a comfortable nest egg. He had accumulated $2 million over a 40-year career. He was 65 years old. He planned to withdraw $80,000 per year, which seemed conservative, just 4% of his portfolio. The 2008 crash happened. His portfolio fell to $1.2 million, but he still needed $80,000 to live on. Now, he was withdrawing almost 7% of his reduced portfolio. He was selling shares at the worst possible prices, just to pay his bills. By 2010, his portfolio was down to $800,000. He had to dramatically reduce his lifestyle. He went back to work part-time. The retirement he had planned and saved for was destroyed, not because he had made bad investments, but because he had not prepared for the possibility of a severe crash early in his retirement. Compare this to another investor I know who retired in the same year with the same amount. But this investor had a crash. Proof portfolio: 25% in cash and short-term bonds, 75% in high-quality dividend stocks. When the crash came, her portfolio fell to 1.5 million instead of 1.2 million. More importantly, her dividend income continued to flow. She did not have to sell shares at depressed prices. By 2012, her portfolio had recovered to over $2 million. She maintained her lifestyle throughout the crisis. She never had to go back to work. She is still retired today, living comfortably on her dividend income and portfolio growth. The difference between these two outcomes was not luck. It was preparation. One investor built a portfolio designed for maximum growth. The other built a portfolio designed to survive. When the crash came, survival turned out to be far more valuable than growth. That is the lesson I want you to take away. Build a portfolio that can survive anything. Own quality businesses, hold meaningful cash reserves, diversify appropriately. Maintain discipline through bull markets and bear markets alike. Do this, and you will not just survive the next crash. You will thrive, and you will have the peace of mind that comes from knowing you are prepared for whatever the market throws at you. That is crash-proof investing. That is how I would build a portfolio today, and that is what I hope you will do for yourself and your family.